Hello and welcome to Earnings Call. Yet another quarter of stellar performance by HCL Tech. Growth on almost all counts, $1 billion worth of deals added, 12 new clients. PAT has grown up meaningfully this quarter. So lots that's happened in the company on the operational front, well, as well as on the management front, because there is a new CEO with us this quarter around. Anand Gupta formally takes charge as President and CEO of HCL Tech, and the top management, along with Anand, join us right now to talk about that. Gentlemen, thanks so much for taking the time out. Anand, congratulations on the appointment, the formal appointment, let me put it that way. But give us some color. I just want to start off with what you've done this quarter and what you could do the next few quarters. Calendar year 13, you had a splendid CY12. Do you think from these levels, on the revenue front and on the operational front, where you've exceeded expectations, you'll be able to continue doing better? 22.5 operating margins, splendid revenue growth all the last 4 quarters. Do you think more is in store for the next 12 months?
So, Neeraj, I think 2012 has been a great year. First of all, thank you very much, and obviously it's a great honor to lead a high-performance team that we have. So 2012 has been a great year for us, including the last quarter, and it's not really a one-year story. It's really about something which we've been building for a while, which we've been saying. So I think they're just culminating into the right elements as we speak. So we fundamentally believe that the market momentum continues. The deal opportunities are there in the market space. As long as we continue to remain focused sharply on the areas that we would like to win, where we believe we can be significant for our customers and add value, I think the momentum should continue.
Anil, stellar work on the margins. Now, I just want to get a color of how did you do it? Because everybody said that you utilized some of your levers last quarter around. You went offshore quite a bit. I think around 150 bips odd came in last quarter because of offshoring. Utilization picked up as well. But wage hikes were to come in this quarter. One, what has been the impact of wage hikes on the overall margins? And two, how did you expand 40 bips QOQ?
So as Anand just explained, there has been a lot of operational efficiencies which have been achieved during the quarter. It's a continuum of what we have been doing for the last 5 quarters, I would say. If you look at the increase in due to the increments, we had a negative impact of about 90 basis points. But it was offset by the improved realization, by using more resources, low-cost resources, by our workforce, by adjusting our workforce in line with the demand. So through these various efficiency levers, we could achieve this higher margin.
So does this last? Because why I'm figuring it is, and I'll come to that in detail later on as well. But you had wage hike impact this quarter, and yet you managed an expansion of sorts, an expansion rather. How would the next quarter look like? Because I don't think wage hike impact comes into play. And if I take off 90 bips, I'm just apples for apples, that would be a significant bump up if other things remain constant.
So this is not the way it happens, because the increment impact, the wage increase impact continues. But as I said, this is nothing called one time here. So it's an operational efficiency which has been achieved.
Okay, so
maybe just to add to what Anil just said. So we've always been saying that our margins is a function of the volume of business we acquire, which and therefore they go through a phase of transition and then into steady state. And then therefore, when they move into steady state, the margin profile is slightly up. When you get a larger deal booking and you get into transition, there's a slight profile of a margin dip, because we always over-invest in that phase of transition. So it's always a function of engagements which are moving into steady state, given that they're large, complex engagements. Therefore, there is a slight quarterly aberration depending on the balance between what comes in and what gets into steady state.
Okay, so I'll have a 12-month to a 24-month question on that too, and we'll leave out the quarters. But just coming to specific verticals, and stellar quarter for you. You would have been pleased with the kind of performance that financial services have done this quarter. 11%. I don't know, I haven't checked the history, but would this be the best quarter-on-quarter growth that BFS has seen over the last 3-4 quarters?
Yeah, that's right. It is one of the better quarters we've had over the last couple of quarters. We did clock about 4% last quarter and 11% this quarter. This is on back of some strong deal wins that we'd had in the first half of the calendar year, which we had spoken about at that point of time. Some of them were large transformation projects which have gone on stream. And, I think that is what's kept the momentum of this quarter going. And it's important to note that, these deal wins in the first half of last year were of a good size, and most importantly, they were transformational in nature. Because we've been focusing on trying to look at what the problem points of our customers are, and then been focusing our service lines to try and address some of the issues that they are facing. And on the back of that, we've been able to show this quarter results.
Yeah, so I'm not taking away from what you did last quarter. I mean, 4% was fairly impressive too, but it's been stellar this time around. What kind of run rate do you think you can clock in? I'm not asking for a prediction about whether you'll do 5% or 7%, but it's just been so phenomenal this quarter. Do you think you can match up to it in the quarters ahead?
I think by and large, the industry is expected to go at a certain growth rate. We hope to clock better growth rates than that on a full year basis. And
what numbers will this be?
difficult to give you a number here, but our targets are that company grows at a certain growth rate. We try and make sure that our vertical businesses grow at faster growth rates than that. So we'd like to see that financial services is performing at a high end in terms of verticals within the company.
And the great engine of infrastructure continues to deliver on.
Yeah, I think, it just goes back, there is such a huge market. We've always been saying there is, a huge market which is there which is getting rebid. The numbers stack up anywhere between $100 to $120 billion. Given our, sharp focus on where we want to participate and our win rates of 50% that we want to keep as a benchmark, I think that will drive momentum for a while. There is, significant opportunity in the market. The markets per se are flat. It's really a market share movement, and therefore we see that as a big opportunity. Infrastructure is one area which is strong, which is, an underpenetrated market for us. So we believe that that's a good play over there. 10.9% growth rate, this quarter versus 10.4 on the back of Q1, I think is excellent. Plus, I think, the point about the integrated deals which are there, where we're saying, which is both application plus infrastructure, is also showing some growth over there. And this really goes into, our strategy of early investment, so whether it is in specific service lines like infrastructure, or if you look at markets. So continental Europe for us continues to be very strong. We're looking at a 6% Q-on-Q growth in this quarter. So I think that is really about placing bets on a few markets where we believe there is significant dissatisfaction. We believe our proposition is much stronger, and therefore we'll continue to kind of remain focused on those selective areas.
So, either of you, last quarter, if I'm not wrong, it was, I think, actually the run on the business machine that actually saw volumes go up. This quarter, while, I'm just comparing quarter on quarter, they may have been a bit of a dip, but 3% is much better than what some of your peers have done. Is it essentially run the business, or that has propped up volumes this time as well, or is there something else contributing?
So I think run the business continues to drive majority of that push, whether it is in infrastructure, whether it is in application, or whether it's in BPO. So, each of them do have a significant, or EES for that matter. So where there is, the markets still are looking at a cost optimization as a key theme, right? And with the rebid market being there, obviously customers are looking at alternate players who may not have been, or who were definitely not there in the previous time when these engagements were signed. So given that there is a strong alternative in the market, a proposition around alternative IT outsourcing, I think will continue to drive that momentum. Discretionary spend, like I said, continues to be a little challenged. It's focused on short ROIs. So while there will be standalone deals which are smaller in size, that continues to drive some growth, as well as expansion in engagements which we enter and run the business, then expanding our value by some of the high value services on EES as well, which kind of chips into that growth.
Okay. Anil, I was reading a couple of reports, and they said that for HCL, and this is of course the view of the analysts out there, I would want your opinion on this. They said that the kind of expansion that has come into margins for HCL Tech recently has been more tactical and not as much structural. Would you agree to that? That you utilize some key levers, like utilization going up, or some bit of offshoring going into play, which is helping margins. But the more pertinent aspects still come into play. Yes, you've done client mining as well, which is helping. But is that a fair assessment, or do you believe that's unfounded, and you would continue to see this upward trajectory on margins?
So before I answer your question, let me give you the background. What is happening in the company? If you look at the company, you look at the 100 million, 50 million, 40 million, the client base, it has significantly gone up. The service adoption index is like 3.8 out of 5 service offerings. So we are surrounding the customer with more and more service offerings. The other thing which is very key here is that annuity-based revenue stream. So more and more revenue stream of ours is annuity based.
Sure.
Long-term 5-year contract where there is a visibility. We do the transition, we do it successfully, and then it moves into a steady state. And this is how Anant explained the margin trajectory in that period of when the transitions are happening. So essentially we are getting more and more visibility in terms of our margins.
Okay.
So I think the street needs to just understand this part. I mean, this is the company which has the best portfolio mix, the best mix in terms of run the business and change the business. So it's surrounding the customer with multiple offerings.
Okay. So in which case, and just to follow up before I come to Rahul again, Anand, while your revenue growth has been good, no doubt of that, if you just look at the last 12 months, maybe there's a bit of a taper off compared to what you did maybe a couple of years before. And your margins have expanded. Now, the belief is that at some point of time, companies in general, if they want to expand margins, maybe revenues will slow down a bit. It's happened with some of your peers as well. Maybe one odd peer has actually managed to do both. And the talk about the stock is that, in order to get multiple re-ratings coming in, you've had a splendid last year. For order to that to continue, you'll probably have to exhibit revenue growth as well as margin growth. Next 12 months, staying down right now, do you believe that you're in a position to deliver both of them?
I think the market opportunity is there. So if you go back to, as an example, on the point about revenue growth versus profit, and is there a tilt towards one? A good example would be, let's say, an infrastructure business, right? 5 years back, we were, sub 5% on margin profile. We were a sub $70 million business. That's grown in the last 5 years to greater than $1 billion, plus the margin has moved up to 18.4%, which we've announced. So I think there's a balance between both. It's not that we kind of try to squeeze the margin profile by investing less in the growth side of the business. I think it's a conscious call between where the markets are, improving efficiencies such as win rates, for example, right? So it's really about how do we extract the maximum mileage for the investments that we put, whether it is in sales or customer acquisition or delivery and so on and so forth. So it's not really about cannibalizing one for the other. So our philosophy continues to be focused around driving growth where required, at the same time squeezing out where we believe that we can kind of get the improvement.
I agree, but my question really is, and you may well not be 100% accurate on this when we talk again the same time next year, but do you believe that the next 12 months you would be able to exhibit both revenue growth and margin growth? I'm not saying you consciously do that, but do you believe that neither of them would be compromised and both of them would move in tandem?
I think the market is there, like I said. So for the market for revenue, I think the market is there. So we should continue to kind of play on that momentum, right? And from a margin profile, I think we are in a range which we would like to play in, right? Given that we would like to continue a very strong booking, given that there is a significant churn we see in the market, and going back to the point that it really depends upon, it's a balance between how much of new business gets acquired, moves into transition, which kind of is slightly below the company average margin profile. When it moves into steady state, obviously then it kind of tapers, increases.
Steve Cardle joins in as well. Steve, good having you. Thanks much for joining in.
Very welcome.
So, looking at the client commentary, looking at what you guys have done this quarter, Europe has been good. Europe has been good last quarter as well. I think this quarter you've done well too. In terms of geographies, I think it's the best performing geography.
Yes, that's right.
How is that shaped up this last quarter gone by, and how do you expect that to do, maybe not over the next 12 months, but at least over the next 6 months?
So I think we continue to see strong growth in Europe for some of the reasons that we talked about last time, actually. So we see geographies that are opening up to the outsourcing wave for the first time. We see pressure. So even Germany this last quarter dipped into recession. So a real driver for significant cost savings. And so we see companies opening up to sort of dialogue that we haven't seen in previous years. And that's been good for HCL, and we continue to have those conversations. So I think our midterm view on Europe will be positive for us because the right drivers are there for us.
Okay, so just elaborate a bit more on that. One of your peers, for them, UK as a market came back very strongly. I mean, I'm not saying that it should be the same for you. I'm just wondering, within Europe as well, what part of Europe? Is continental Europe contributing significantly? And for you, what will do well over the next 6 months?
So we have a very strong position in the UK market, but I would say for us, the UK growth we saw in the last sort of 12 months, continental Europe is particularly interesting for us. Switzerland, Germany, where France too, but we see those markets opening up to the sorts of conversations that are interesting us, perhaps for the first time. So I think we'll see more out of the continent actually than we will out of UK or Nordics, let's say.
A couple of other points. Steve, just wondering, you mentioned about how continental Europe would do vis-a-vis UK, and UK has been a good factor for you till now.
Yeah.
What's the nature of the wins coming in? I mean, Anand kind of gave a brief color on that, but what's the nature of the wins coming in for you as a consolidated entity? And are these coming in at better pricing than what used to come earlier? Because I see this time around, if you can correct me if I'm wrong, but your revenues have grown primarily because of slightly better pricing as well compared to, volume growth, because volumes have dipped QOQ, but pricing probably has gone up.
The realization is better also.
Yeah, so realization is better as well. So how is that, is it coming at better pricing than new deal wins that you'll be having?
So firstly, just to talk about the shape of the deals. So it's a mixture, but typically we're seeing quite a lot of multi-stack deals, so infrastructure plus apps, or infrastructure and BPO. So Europe is seeing quite a lot of multi-service line deals. The second thing is we probably see more first-time outsourcers in Europe than we see in, say, the Americas region. There it's typically rebid market that we see going on. And so in some manner there is an ability to help educate and inform that process. So at times we can see a slightly better pricing position, slightly better realization in those markets. So I think you see those factors coming together in the European market, which is why for us I think it's a good market for us to be playing in. And certainly as you've seen, we're building a good position in that market.
And Anand, a couple of key exits. Vineet, of course, has not exited, but there have been a couple of key exits, and one in European market as well. You do not think that will be an issue at all?
So before I answer that question, maybe just to add to Steve's point on the previous question, Neeraj.
Sure.
I think, we've said it, when you look at the total outsourcing kind of contracts, labor is one component of it. And therefore, when customers are looking at cost savings, it's not about the unit price of labor alone. It's the entire business case that a customer would get over a 5-year period for their IT spend. So, spend like data centers, spend on licenses, spend on third-party elements, and therefore, as an outsourcer, where we, our focus really is on trying to see how we can optimize those elements and therefore provide an overall business case. So, which is what really is what the customer is looking at. So it's not about the unit rate per se.
Sure.
And so that's the other key point, especially when you're looking at a total outsourcing business. Because the levers of productivity, levers of those elements, especially in second-gen outsourcing engagements, is kind of already being used to a very large extent, right? So coming to the, specifically on the media reports around some of the exits, I think fundamentally they're incorrect. Some of the exits have been done because of performance reasons, and some of the exits have been where individuals have unable to kind of keep pace with the pace at which the company is growing. So I think largely that's driven by that element. So we continue to have a high-performance leadership team, and therefore, where we are looking at, as far as the leaders are concerned, as long as they continue to exhibit performance in the outstanding bracket, I think, that's where the, because at the end of the day, that's where they're going to lead the rest of the organization. So we've actually not lost out a single leader who has been in the outstanding bracket, which is nearly top 30% of our, the way we kind of look at the performance of individuals.
Okay. Final question really. You've done very well in terms of your operational performance this year, calendar year 12. Calendar year 13, assuming nothing goes terribly wrong on pieces that you can't control, you think 24% is not out of the woods? Not out of, could it be achieved?
So,
I'm not asking for a guidance. I'm just asking you, do you think it's reasonably possible to get margins, OPMs of around 23.5–24%?
So first of all, let me in addition to the profitability performance, there has been a huge performance on the working capital management,
sure, of course,
as well as the return on capital employed. If you see this quarter, our return on capital employed has been 35%, which is one of the best in the industry. Our cash flow conversion has been more than 100%, 140% this quarter, which is also very good. So we are on a solid footing, and as Anand explained, that there is opportunity. There are opportunities in the market.
I'm taking that as a yes. It's possible. It's conceivable that you may probably even touch those numbers.
So we stay away from guidance. So.
Okay, fine. Final question, Anand, to you. I just read your result release, and you've stressed a bit on alternative outsourcing, if I'm not wrong, if I'm using the term correctly.
Sure.
Just leave us with what you mean by that, and I mean, how would it help business in HCLTech, as you, of course, take over officially from today?
So alternative IT outsourcing is something we had been positioning for a while. First, it was around total outsourcing, and really it was fundamentally about driving business case benefits to the customer, which is not labor centric. So if you look at $100 as a total IT spend, and let's say about 65% of that is RTB, only about 60% of that is labor. So how do you impact 30% of that is really where the market is going, right? So whether it is in let's say in IT technology like storage or computing or the licenses and servers. So, from our standpoint, when we position our alternate IT outsourcing in that market, it's all about how do you realize a full benefit across the portfolio. If you apply the same framework into, let's say, application development, support and maintenance, the industry is not new. It's a fairly heavy offshore-centric market. So our strategy really is, the levers which were there, which are typically around utilization, onshore, offshore, pyramid, etc., are kind of pretty much already done. You can get some marginal impact from there. But I really think the big thing for us is really driving what we call proactive obsolescence in that space. So, our objective, just like in the total outsourcing or RTB side, will be to actually reduce the workload. So as an example, if you get 1,000 tickets in application support, why are you really getting 1,000 tickets, and why should you not optimize the landscape so that you get a reduced workload itself? So that's an alternate form of outsourcing in that space. Or if you take the paradigm in BPO as well, Steve alluded to the fact that we're seeing a lot more transformational elements of BPO as well, of business services. So our expertise around business benefits realization that we have with the ES, coupled with our expertise around enterprise transformation services and BI and analytics, will further drive the business services portfolio. So it's not about just moving 1,000 people in, let's say, F&A, but actually reducing it maybe down to 600 or so. And that really can be driven by a strong understanding of the business, which comes through our ES portfolio,
sure,
and of course our BI and analytics skills. So that's what we're kind of positioning as alternative sourcing, coupled with a lead that we took in the market around as a service business model. So we launched MyCloud close to about 3 years back. So we fundamentally see as a service coming in as well. So how do you take all these components in and still provide a value proposition to the customer and still be relevant to the customer? So really, the strategy is around that.
On that note, gentlemen, thanks so much for taking the time out and joining us, and all the best for the year ahead after the stellar quarter. Hope you do a better performance or as good a performance in the calendar year 13. Thanks so much for taking the time out.
Thank you, Neeraj.